A conventional mortgage is any mortgage that is not backed by our government in the form of a guarantee or insurance. A conforming mortgage is a mortgage that conforms to the guidelines set forth by Fannie Mae or Freddie Mac. So, while all conforming mortgages are conventional, not all conventional mortgages are conforming. For example, a jumbo mortgage is a conventional mortgage that doesn't conform to Fannie Mae or Freddie Mac's guidelines because the loan amount exceeds the conforming limit. Another example would be a bank portfolio loan where the bank lends their own money according to their own rules so that the loan doesn't have to meet conforming requirements. There are several important things that a borrower should understand about a conforming mortgage. So first, let's give some background information on the mortgage business. When you go to a lender to get a mortgage, there isn't an endless supply of money to give people. Think of a lender as a buyer and seller of money. They purchase at one price and sell at another. When they sell the loan, the money they borrowed is paid back and the profit is used to run their business. This process simply repeats itself over and over with new borrowers. Prior to the financial crisis, the interest rates lenders quoted for a mortgage were basically the same. The lender would simply make small adjustments based on their cost of doing business. As loans started going bad during the financial crisis, Fannie Mae and Freddie Mac realized they needed to make serious changes and do it quickly. In April of 2008, the markets were in the thick of the financial crisis. With foreclosures mounting, Fannie Mae and Freddie Mac were losing significant amounts of money, so they introduced loan-level pricing adjustments, or what are referred to as LLPAs. These LLPAs are simply risk-based adjustments to the price of money, very similar to what you may find from an auto or health insurance company where the premium you pay is based upon the risk of the policy. These risk-based LLPAs impact the cost of money to a lender, which is then passed on to a borrower in the form of either higher interest rates or fees. The same loan with several risk factors will cost a borrower more than a loan with fewer risk factors. This is a reason that two borrowers may receive completely different interest rate quotes for what may appear to be the same loan. These fees are also cumulative, so if you have 4 different risk factors, the cumulative cost for all 4 will be passed on. Some examples of LLPA risk factors include credit score, property type, occupancy of the property, the number of units the property has, and the loan-to-value of the mortgage. All these things and more can impact the overall cost of a conforming mortgage. A conforming mortgage with less than 20% down payment or equity if you're refinancing requires private mortgage insurance, which is commonly referred to as PMI. PMI is a form of insurance that protects the lender should a borrower default on the loan. All conforming mortgages with less than 20% down payment require some form of PMI, and your loan officer can detail what your options are. They include a monthly premium that is part of your mortgage payment, a one-time single premium that can be paid at closing, or the cost of PMI may be built into your monthly payment in the form of a slightly higher interest rate. A borrower may even choose to utilize a combination of these items. The cost of PMI is also risk-based, just like the LLPAs discussed earlier. A higher credit score will reduce PMI premiums, as will higher down payments. Other factors that impact PMI premiums are the overall term of the loan, the type of loan such as a purchase or refinance, and even whether or not cash is being taken out with the loan. When you take out a conventional mortgage that has more than one borrower, the lowest middle credit score for any borrower on the loan is what is used to qualify for both LLPAs and PMI. For example, borrower A has a TransUnion score of 760, an Equifax score of 784, and an Experian score of 712. Borrower B has a TransUnion score of 678, an Equifax score of 720, and an Experian score of 677. In this example, borrower B has a middle credit score of 678, which is lower than the middle score for borrower A of 760, so the 678 score of borrower B is used to qualify the pricing for the interest rate and or fees, as well as the PMI if less than 20% down payment was used. Also, when you have multiple borrowers on a conventional or any other mortgage for that matter, the income and debts from all borrowers on the loan must be considered. This means that a lender cannot consider income from a borrower that does not credit qualify, for example, or cannot ignore debts from any borrower that is obligated on the mortgage. There are many conventional mortgage options for both fixed and adjustable interest rates, as well as a variety of loan terms available. Conventional mortgages include special programs for first-time buyers, as well as borrowers that are looking to renovate or remodel, for example. Not all lenders will offer all of the different conventional products that may be available in the market. Qualification guidelines from Fannie Mae and Freddie Mac are similar, but also vary in many key areas. A lender may be forced to deny a loan because they only sell to one of the two agencies and the loan parameters don't meet guidelines from one. Prime Lending, as a direct seller to both Fannie Mae and Freddie Mac, isn't forced into this position. A conforming mortgage will typically come with better terms compared to other conventional mortgages due to the economies of scale and liquidity that meeting guidelines from Fannie Mae and Freddie Mac bring. This is because after your lender closes your loan, it is sold into securities by Fannie Mae or Freddie Mac, which are then purchased by investors. Knowing that your loan meets specific minimum guidelines, it helps ensure the quality of the investment that these investors are purchasing. A lender may choose to have a guideline or even guidelines that are more restrictive than what is required by Fannie Mae or Freddie Mac. These more restrictive guidelines are referred to as overlays. An example of an overlay would be a lender that requires a minimum credit score on a mortgage of 640, when Fannie Mae or Freddie Mac would allow a minimum credit score of 620. Overlays can come in many forms, and this is the reason that some lenders can close loans that others can't. Being a direct seller to Fannie Mae and Freddie Mac gives Prime Lending an advantage over other lenders in this area as well. Guidelines for conventional and conforming mortgages change frequently. For more information on this topic or any other mortgage topic, please reach out to your Prime Lending loan officer.